Let's get the market housekeeping out of the way. Last regular session close, $30.64, Friday, December 26th. After hours traded near $30.47 per sources compiling stock market data. That's the immediate, what I would sell/buy at, number. Trading range that session, about $30.15 to $30.82, tight day, not a panic dump, not a euphoric bungee jump. 52-week range, $25.71, low, to $66.44, high, a reminder that the stock once reached the stratosphere and has since come back to earth. That gulf is part of the story, huge upside potential once, big drawdown since. Why does that matter? Because investors are deciding whether the current $30 price is a discounted entry to a multi-year AI growth story or a value trap caused by repeated misexecution. The market's answer will depend on the next few quarters. Smci sits in a tug-of-war that's easy to describe and hard to resolve. Bull case, the company is a direct play on rack-scale AI infrastructure. Cloud providers and enterprises are buying racks of GPU servers and the supporting gear to run massive AI workloads. Supermicro's product portfolio, from air-cooled units to direct liquid cooling racks and integrated GPU platforms, is squarely in demand. Management touts massive order books and Blackwell Ultra-sized orders that suggest large, growing revenue streams ahead. Bear case, recurring timing and delivery issues, the company's tendency to miss near-term guidance, margin pressure in system sales, and a very elevated level of short interest. Add to that a history of accounting scrutiny and late filings that make some investors cautious, and you get the skeptical camp. Put simply, the market believes the end market is huge, but some investors don't quite trust how quickly Supermicro can capture that demand, or whether it can do it without bleeding margin or disappointing guidance. Smci traded in the low $30 into the final week of 2025 and remained well below its 52-week high, a fact that underscores the market's reassessment of expectations. Data compilers showed a Friday close at $30.64 and after hours around $30.47, leaving the stock far from the $66 range it once flirted with earlier in the year. That pullback has investors debating whether the correction is a buying opportunity or a signal of deeper issues. The 6-month underperformance is notable. Some research outlets flagged that Smci had fallen around 34% over the prior 6 months, while similar industry stocks were doing better. That divergence fuels the turnaround versus trap debate. If you buy into the turnaround story, that 34% decline looks like a discount. If you're worried about execution, it looks like a warning siren. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Let's talk about the mechanics of the misses, because the devil is not in the details, it's in the shipping schedule. Over recent quarters, Supermicro pre-announced or reported revenue that came in below initial quarterly expectations, and management explained much of the shortfall as timing-related, meaning orders pushed out to the next quarter rather than cancelled. Reuters and company updates described the latest example. Q1 fiscal 2026 revenue reported around $5 billion versus analyst estimates nearer $6 billion, with the company pointing to customer delivery schedule shifts. These aren't tiny misses. Management trimmed or adjusted near-term revenue expectations on multiple occasions, and while the company often reaffirms or raises long-term guidance, for example, upping FY 2026 revenue targets to at least $36 billion in some updates, investors increasingly treat short-term guidance with skepticism because of the repeated timing shifts. The market has essentially placed a trust haircut on near-term guidance. So the core problem is usually timing, not demand. Big orders exist, but shipments, certifications, or deployment windows get delayed, and that delays revenue recognition. For investors who rely on quarter-to-quarter prints, that's frustrating and feeds headline-driven volatility. Timing explanations help because, if orders are real and merely shifted, revenue will arrive later and the long-term revenue picture can remain intact. But timing explanations hurt because they erode credibility. When guidance is missed repeatedly, investors stop taking it at face value. They create lumpy earnings. Big AI rack deals are multi-billion-dollar and infrequent. If one big rack ships in Q2 instead of Q1, one quarter looks terrible and the next looks amazing. That lumpy pattern complicates valuation. They make short sellers more comfortable. If the company can't deliver predictably, shorts can profit from spikes of disappointment amid general enthusiasm. Think of it like a pizza chain promising 100 new franchisees this quarter but having contractors delay build-outs. The demand, people wanting pizza, is there, but the stores aren't open yet. Investors want the pies now, not a post-dated check. One of the most eye-catching parts of the Smci story in late 2025 is the elevated short interest. Multiple trackers show about 89 million shares short, representing roughly 17–19% of the float depending on the data provider and date. That's a very high short float for a large cap. For example, Finviz, Benzinga, and Stock Analysis report short interest in that neighborhood. Why is that important? High short interest can amplify volatility. A piece of bad news can accelerate selling, while a huge positive surprise could trigger a rapid squeeze higher. It signals that a sizable group of investors are betting against the company's short-term trajectory. That doesn't mean the shorts are right, but it does mean the stock is structurally set up for bigger swings than a low-short stock. Imagine a soccer stadium where 1 out of every 5 fans is secretly rooting for the other team. That's SMCI's market right now. Many traders are actively betting against the stock, making elections of sentiment more dramatic. The valuation argument: why it still looks cheap to some investors. Despite the drama, the long-term valuation story is where the bulls get loud. Some analysts and commentary outlets argue that excluding the near-term noise, the company trades at roughly 17x forward free cash flow while growing revenue at around 30% year-over-year in certain projections, metrics that make the stock look reasonably cheap relative to many high-growth tech names. Several investor pieces and valuation posts summarize the 17x forward FCF math and similar growth expectations. If you believe AI-driven demand continues to ramp, and Supermicro converts its order backlog into revenue over the next 2 to 4 quarters, and management improves execution and margins, then a 17x FCF multiple with 30% top-line growth looks like a bargain relative to growth comps. That's why the value versus trap debate persists. The fundamental bull case in plain language. Let's state the bull case simply and colorfully: massive end market. AI racks and data center systems are a huge, growing TAM. Supermicro is a pure-play system supplier with products designed for next-gen GPU platforms and direct liquid cooling, stuff cloud builders need. If global AI deployments keep exploding, the pie becomes enormous. Order book and backlogs. Management points to sizable order inflows and mega orders that, even if delayed, won't disappear. When those ships sail, revenue recognition follows. Valuation discount for a growth story. If you accept the forward FCF multiple thesis and the growth projections, the stock price today can look like a juicy upside risk-reward. By the rumor, own the execution play. Imagine a rocket factory facing supply chain delays. The orders exist, the rockets are paid for, but if the engines aren't installed on time, the launch slips. When engines arrive, you either watch the rocket lift or you wonder why they spent so much on rocket paint. Bulls are betting the engines arrive and the launch happens. Bears are watching for more technical glitches. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.